Now the fun part of cost accounting or managerial accounting. This is really a lot of fun. The only problem is we're doing several kinds, so you really have to keep your focus. So bear with me as we go through these. We're going to be looking at flexible budgets, and then we're going to look at variances, and then we'll look at different kinds of variances. So that's why it's going to be a little bit of, you'll have to switch gears. First of all, let's look at this flexible budget. And this is telling us the selling price that's budgeted is $18 per lock. The variable cost is $12, and the budgeted fixed costs are $12,000. So your variable costs, you're just going to ride right into the quantities here. So that's a simple matter of multiplying 6,000 times 18, 6,000 times 12, plugging in the fixed cost, getting your total expenses, and then coming up with the operating income or loss. Fairly simple. Just have to remember you've got a variable cost and you have a fixed cost. So one should be pretty good, pretty easy to complete. Now we're looking at, let's switch gears here. Okay, this is what we thought it would be. This is what it really is. Now the difference between the two, even though we budget something, we really do have to look at the actual cost and have those recorded. So we're going to look at finding the differences and whether it's favorable or unfavorable. So if we budgeted 10,000, our units are the same. So any variances here are going to be very obvious. You only have one type of variance, so to speak. You don't have this quantity variance. So these are going to be differences in materials and costs. And so we've got actual units, okay? So here's the actual results at the actual prices. Here's the actual number of output units. So output units 10,000, 10,000. We're good to go. So, but now we budgeted 150,000 for revenue and we had 170. So there's a difference of $20,000, correct? Is that favorable or unfavorable? Well, we're getting more than we had, so in this case it's favorable. Let's look at the costs. So we budgeted 49 and there were 52. 52.1, 49.7. So the difference between those two, obviously this one's more, but it's a cost, and so that would be an unfavorable. It costs more than it should. Fixed cost, oh my, we had fixed cost of 14,600 and our fixed cost were actually 15.7. Again, we're looking at an unfavorable. So when you add these all up, your total expenses okay, which are these two, had an unfavorable, correct? But when you look at the operating income, we had a favorable, and that's because we had a larger sales revenue than we thought for the same amount of units. So you can kind of get a feel for you. Again, you have to really concentrate to see what you're doing here. And there's the form to fill out. I gave you what you're shooting for, I guess. Now this one now we have an issue where we have the price it's supposed to be here, the actual price of it, the quantity, and how much we're supposed to use per bottle. And we have, no, that was the actual quantity we use of material per bottle. Here's the standard, and we should have used 9.9 pounds per bottle. And then this is how much we should have used, and this is how much we did use. Now, we know, just looking at this, the actual price per pound was higher, and what we used was higher. So I'm pretty well looking at this thinking, yeah, we're probably going to have an unfavorable variance because everything was higher than what it should have been as a cost. But we don't know which was more. Okay, so we're going to look at the actual price, which was 55. We've got two types of variances going here. We've got the material variance and the efficiency variance. So we're going to look at the actual price, which is 55, versus the standard price times the actual quantity. And that will come up with a variance. And if you define that would be actual price times the actual quantity, give us this total. Standard price times the actual quantity, give us this total. So that's going to tell us how much too much we paid. So that one's going to become an unfavorable variance. And we know it's going to be unfavorable because both sides are high. Now, and I've actually written this out for you so you can see, we're going to look at the actual quantity times the standard price. The standard quantity times the standard price. This is what it should have cost us at the standard price, and this is what it should have cost us. This, we're now measuring the efficiency or the quantity. So when you add that up, you're going to you'll multiply that out, and the difference here you can see is a pretty wide distribution, okay? And you're going to end up overall with a 2,201 unfavorable variance. But you'll know the difference between the price variance and the efficiency variance on how much material you've used. So that's when you look at, you're looking at here, materials. And this is the material price variance, which is this one right here. And I should have put that on your copy. And the materials efficiency variance. So, and now we're going to go down to one where we look at the labor price variance and the labor efficiency variance. And we're going to do the same thing. Okay, you're going to look at the actual price versus the actual quantity input. And I'll give you a hint here as to how that lays out. This one, we're looking at the actual price of 15 and the standard price of, actual price of 14, the standard price of 15. So, you know, you're looking at that, you're thinking, well, we should have paid 15 and we got 14, so we probably came out ahead. But we don't know. So now you're going, for sure, you've got to look at both ways. So now look at the direct efficiency, and you're going to see a problem. The actual quantity used was 2,667 hours. The standard quantity that should have been used was 1,700. So we used more hours than we should have, right? But we paid less for it. Now the question becomes, is because we paid less for that, is that way we use more hours? But right now we're just going to figure out the variances. So you're going to use the actual price times the actual quantity. You're going to use the standard price times the actual quantity and get totals here to get a variance. That should be a favorable variance, I believe. Then you're going to take the actual quantity input, which is going to be this 2267 times the standard price, and you're going to take the standard quantity, which is 1,700 times the standard price. Add those and multiply those out and then get a variance. Now this one will probably be unfavorable. So, and then you're going to come up with an overall unfavorable, and that overall, I'll give you a number to shoot for, is 6283. That should be unfavorable. So you can see you can nail down what is causing the variances back and forth. And we have the next one, and you can see how you have to concentrate on these. This one, we're looking at creating overhead, or finding our overhead cost by allocating it via the direct hours, okay? So we're saying our budget variable overhead is allocated on 1,500 hours at $7,500. So how much is that an hour? Well, you're going to take 7,500, correct? And divide it by 1,500, and that should come up with about $5 an hour. You're going to do the same thing with the fixed rate. Now this is just the first part, so that's 3,000 divided by 1,500, and that's a no-brainer. That's $2. So now you have $5 and $2 for allocation. Okay. And they kind of make this problem more complicated than it needs to be. So if you read this, fill in the numbers that they give you, okay? First of all, they give us 10,000 variable, and then fixed overhead is 27,600. So our total actual cost was 13,260. What should it have been? Well, we're going to take our actual, we had 1,500 hours, okay, times 5, should have been 7,500. Oh, that didn't come up very well, did it? Should have been 7,500. This is going to be 3,000. This is what's been allocated. Now, if I add that together, my overhead for this, and they use some squirrely numbers, and they all kind of run together, should have been 10,500. It was 13,260. So the difference for the variance is what? It's this 2760, and that's unfavorable. It's a very odd, the numbers they used are very coincidental, okay? So we should have had an overhead of 10,500, and we had an overhead of 13,260. And we're trying to show you how overhead was allocated for to use for direct hours. So that kind of gives you an idea there. And we have one more. And this one I think you can do on yourself, on your own. I don't think you have much trouble with it. These budgets are a lot of fun, and they're very interesting to watch and look at as the numbers change, so that you can do predictions and make good management decisions. So I'm going to let you go on this one. Message me if you have any questions whatsoever on this. This one, again, let's go back through here really quickly so we can see. This is allocation of overhead hours depending on the direct labor hours. That could have been dependent on anything out there. And you would have found that by dividing and then coming up with the per hour. This one, we're looking at efficiency. We did 2 of them. We're looking at what happens if you can't tell which is giving you the unfavorable variance. Is it the actual price, or is it the actual hours used? So you can break it down by the price variance or the efficiency variance. This one is same thing, just looking at it from a material standpoint. This kind of set us up for our variances when you're just looking at one difference. Now, if this had 12,000 and this had 10,000. Then we would have had to have looked for price variances, right? Price and efficiency variances in there to figure out which weighed the heaviest. This right here was when we started with, just showed us how to make a flexible budget, looking at different units and seeing what the costs were going to be. So I hope that has helped you. As we go through this, I lost my, oh, there it is. I lost my controls for this. Have a good day, okay? Email or better yet, message